Abby, so good to see you. We have big news. High earners ages 50 plus are going to lose a major tax break. Starting next year, workers age 50 and older who earn more than $145,000 will lose a key tax break for their retirement savings. What's new?
So starting in 2026, any catch-up contribution is going to have to go into the Roth bucket in your 401k. So if
Mhm.
you're 50 plus in 2026, that's up to $8,000. It used to be you could put that away in the tax deferred bucket in your 401k. That would reduce your income even more, delay taxes a little bit more, and help on the tax bill. Since the new regulations have come out, it has become very clear that catch-up contributions, all of them, have to go into the Roth portion of the 401k. So if you're 50 to 49, that's $8,000. If you're 60 to 63, there's a new super catch-up is what it's called. That's up to $12,000.
Mm.
And so that's enough to potentially change your tax bracket even,
Yeah.
and really create some surprises if you're not aware that this is going into a different bucket and also being shown on your tax return for the following year.
Yeah, this is a big difference. So, just to say it again, before workers could reduce their taxable income with those pre tax catch up contributions. So, how will this switch to after tax Roth contributions change take home pay and future withdrawals?
So it's going to change take home pay because even though you're not receiving that money as income, it's being tucked away for your future for retirement, you're still going to be taxed on it. So that will potentially reduce your tax home pay by maybe even up to several $1,000s. It depends on the situation, of course, but it will have some effect. You might want to maybe even change your withholding a little bit if this is going to make a big difference for you. So it's a good time to just review what options your plan has, review how much you have going into your 401k in just regular contributions and then also the catch-up contributions so that you can see the effect that this is going to have. Now, the good news is once this goes into the Roth portion, as long as you follow the withdrawal rules for Roth money, which are not too difficult, basically just don't touch it until you're retired, 59 and a half or older,
Right.
then it's going to be fully tax free. So all your contributions are always tax free, but also the earnings are tax free on Roth money. So it's kind of like, there's a little bit of pain now. You pay the taxes now, and then you get to enjoy that tax free in retirement. When taxes are potentially higher in the future, we're in a pretty historically low tax rate environment. So while this might feel like a little bit of a setback for people as far as their cash flow these days, it really is long term a pretty positive thing. When you look at it as far as you're going to have some extra tax free money in your retirement, which is
Yeah.
never bad.
Right. And so that Abby, that does bring us to the $1 million question, right? Which is a lot of people are wondering if they should be contributing to tax deferred right now or putting all their money in Roth. How do they determine what's best for them?
Yeah, that's an intricate answer. I wish I had an easy rule of thumb to just say, do 50-50 in each, but it really is dependent on your tax situation. So if you're a high earner on the top here, so if your marginal tax rate is like over 24%, then you're probably going to want to go pretty heavy on traditional to get some of that income down because it could trigger other taxes like the net investment income tax, and some other taxes on capital gains, those sort of things, because taxes really have a domino effect.
Yeah.
So if you're in a really high income year, if you got a big bonus or maybe you sold your business, then you're going to want to put some extra in tax deferred accounts. If you are in a regular income year and your tax rate is, I would say the marginal tax rate 22% or lower, then you're probably want to go Roth. And that's because if you look at the historic tax rate tables, we don't want to get too complicated with it, but you can see a steady decrease over the past 10 years, especially. So we're in, like I said before, a historically low tax rate environment. We want to take advantage of that, pay the taxes now so that we don't ever have to worry about that again. It also gives you a lot more control in retirement because depending on what your income is, your Social Security could be taxed. Right now, only 85% of it can be taxed, but we all know Social Security trust fund is drying up. And so probably that's going to increase to 100% of your benefit being taxed at certain income levels. Medicare surcharges, so you have to pay extra for Medicare when you have certain income levels. And if you're withdrawing from regular 401ks or traditional IRAs, all of that is 100% ordinary income. And you don't have control over how much income you take out. You have to pay the bills or you have to take distributions because you're of a certain age and the government says you have to. So paying the bill now, while it feels painful, and nobody likes to pay tax, and nobody wants to volunteer to pay additional taxes, but your future self will thank you. So just keep an eye on your marginal tax rate. You can find that on if you use a CPA, you can ask them, or you can usually find the comparison. So from 2023 to 2024, you'll see at the bottom what your marginal tax rate is or what your effective tax rate is. So that's a good place to start for figuring out, what do I want to defer? What do I want to go ahead and pay the tax on so I can benefit in the future? And typically what we see when we do an analysis on this is some kind of a mix of the two. And the mix just depends on your income situation for the year.
Mm-hmm. For those people, though, who are really married to and love that tax deduction, would you recommend other strategies like HSAs or other tax advantaged accounts to help make up for this lost deduction?
Yes, definitely. So if you are in one of the categories where your income is really high and you're just looking for a tax break because the tax bill has gotten to be too high over the past several years, then there's a specific category. So if you're in the category of a high earner, which is $145,000 or above in the prior year, but you're married, there's a higher threshold for being able to make IRA contributions that are still deductible. In 2026, you can sock away up to $8,000 in an IRA. And if you're married, then you can do double that. Even if your spouse isn't working, you can do a spousal contribution. So that's a way to defer some more taxes. And instead of doing a catch-up contribution, which has to go into the Roth 401k, you can just do a individual, an IRA, an individual retirement account contribution, and still deduct the same amount that you did in the prior year. So that's a big one. If you're single and earning over 145,000, you're not going to get a deduction on an IRA contribution. You're over the limit. So that's not going to work there. However, both categories, whether you're married or single, if you're a high earner and you have a high deductible medical insurance plan, 100% look into an HSA. It's one of the only, it is the only triple tax advantaged account. So you can see here, you get a tax deduction going in, the growth is all tax-free, and all qualified withdrawals are tax-free. Wow. And it's those withdrawals are very retirement friendly. And I believe they're going to get more and more flexible to where if you're in retirement and you have an HSA still, I think in the future, they're going to let you treat it basically like a Roth IRA. So I would put as much as possible in an HSA if you have the ability to do so.
Mm-hmm. It's interesting to talk this through with you, Abby. It's apparent that this is all kind of a moving 3D puzzle, which I know you enjoy solving for people. So clearly no one answer, but if somebody wants to talk about, these catch-up contributions or tax diversification or how it fits into their overall financial plan, what's the best way to reach you?
You can always give us a call at 678-442-0255. Visit our website at theretirementfamily.com. We have a lot of great resources on there, calculators, all kinds of things that you can use to explore these kinds of topics more. And you can also send us a message. You can give us a call, send us a message, let us know what's on your mind, what you would like to talk to one of our advisors about, and we'll set up a 15-minute complimentary phone call with one of our advisors to talk through your concerns and questions.
Great. Abby, thank you.
Thanks, Erin.